this week was another important one for inflation, and we think it's fair to say that the Fed is taking a little sigh of relief after the data that just came out. Not a victory lap by any means, but certainly a better outcome than the street was worried about after the Fed held rates steady in July. And after that, a few weeks ago, Chris talked about the inflation expectations, and now we can talk about the recent results and what that means. So we received two major inflation reports, CPI, which measures consumer prices, and then PPI, which looks at producer prices, so a little bit earlier in the supply chain. So starting with CPI, headline inflation rose just 0.1% in July, so that's month over month, and then came in at 3.4% over the past year. So those are both about in line with expectations, but more importantly, core inflation came in at 2.5% year over year. So that's continuing to show a fairly contained underlying trend. Chris also did discuss that difference between headline and core inflation and how higher energy prices were really the reason for much of that gap this year. So I'm bringing a chart on the screen right now, and you can pretty clearly see, and this is from the US Bureau of Labor Statistics, that headline inflation in blue jumped in May as energy prices surged, while core inflation in the green stayed below 3%. And then since then, headline has started to come back down and core has moved back to 2.5% after this week. So the important point this week is that we didn't see another acceleration. Another reason for the Fed to breathe a little easier, the producer price index was completely flat in July, and year over year, that number fell pretty meaningfully, and markets definitely reacted kind of nicely to that. Think of PPI as a little bit further upstream from the prices that we all see at the grocery store or the gas pump. So if businesses aren't seeing their prices rise as quickly, there's usually less pressure for them to then pass those increases along to consumers. So what does all of this mean for the Fed? Really, it buys them time. Just a week ago, markets were putting roughly a 55% probability on another Fed rate hike. And then following this week's numbers, that probability has fallen to around a third. And that's really the key takeaway. Inflation is not back to the Fed's 2% target, but it's also not moving meaningfully in the wrong direction. So that means the Fed doesn't have to rush into another rate hike. And at the same time, we don't think this means rate cuts are necessarily right around the corner. But then from an investment standpoint, that's generally a more comfortable environment for both stocks and bonds than one where the Fed is being forced to tighten policy again. So we'll continue to keep you updated. As always, please reach out to the team if you have any questions.